Thank you for joining us today to hear from Strix Group plc, who announced their results earlier this week on Wednesday. These are the full year results. This morning we will hear from both Mark Bartlett and Raudres Wong, who will talk us through their presentation, and then there'll be an opportunity for Q&A at the end. As a reminder, if you haven't seen it already, you can find a note with forecasts on our website at Equity Development. Otherwise, without further ado, I shall hand over to Mark.
Good morning, everyone, and thank you, Hannah. So welcome to this update from Strix on the full year results. We have a fairly extensive deck to run through, so we're going to do it relatively quickly, as Hannah insisted that we give you at least 20 minutes of questions at the end. So without any more ado, we will start with some highlights for 2022. So first of all, I think many of you have heard many times now about all the headwinds in 2022. We had the China lockdowns, we had the conflict in the Ukraine, obviously the cost of living crisis, which definitely started a recessionary environment within our kettle industry, interest rate hikes, and of course the usual volatility in commodities. They're all very, very challenging, particularly in the last quarter of 2022. As a result, over the full year, we saw a drop of 10.5% in our revenues and a 27% drop in our PAT, driven primarily by the unprecedented drop in the kettle market, and that was primarily in the regulated market in Q4, which we'll touch on further in the presentation. However, despite all of those headwinds, we still had quite a number of positives that I'd like to bring out in the summary at the start here. First of all, we improved our cash to EBITDA ratio back to 61%, getting much closer to the norms of Strix Core, which is around 70%, and we're obviously looking to improve those as we go forward. We saw some of our own brands growing particularly well. The Aqua Optima grew by 49%, in a market that declined around 16% during the course of the year, so very strong performance. Within the kettle market, we maintained our share, if you exclude the regions around Russia and the Ukraine, at 56%. And we saw significant improvements in our new factory, which has only just been opened, but we've already seen a 6% increase in efficiencies year on year. And we've obviously seen some increased diversity in our business with the acquisition of Billi later in the year. Internally, we've done a little bit of functional restructuring and streamlining. We brought in a new sales director to really focus now on those face-to-face contracts, particularly as the world is starting to open up, which we'll touch on a bit later on. And we've also put some resource in to increase our focus on logistics, procurement, and the distribution costs in the business. Again, really trying to drive costs down in our organisation. We start the year being net zero compliant, as we've committed to, and in fact we've exceeded our targets. We had a target of offsets of 5%. We actually have got down to 3% offset. So very, very pleased with the progress we made on our ESG strategy. And of course, we made a transformational acquisition with the addition of Billi in November, which we'll certainly touch on further as we go through the presentation. Now, as you are aware, we had a couple of announcements at the back end of 2022, and that was particularly around the Q4 disruptions in the regulated market. And now that data's out, we can actually see during the period from September to November, the market was down 37%, 44%, and 38% respectively. So absolutely unprecedented. I've never seen those sort of levels in my career. In December, we also saw the impacts of COVID. We started seeing a couple of the OEMs being locked down in the very end of November, first week in December. And then the world just seems to change. So in the first week of December in Strix, we had 0 COVID cases in our factory, and we hadn't had any reported cases through the whole of that COVID period. By the end of the third week of December, 60% of our workforce were off with COVID. So it really did just run through the factory. I'm pleased to say, as you look at the business in the world today now, China has changed completely. We probably had one of the highest return rates after Chinese New Year with 100% return. No masks, completely operating as normal. And we've seen that across the rest of the OEM base as well. So a return to whatever that new normality is. And we remain very confident that the markets will return back in all historic periods where we've had financial crises or pandemic type environments. The market has always gone back to a 5% CAGR growth. So really, it's much more about a question of timing rather than when it will, or rather than if it will happen. It's more a question of when. And I think one of the things you sort of see in the RNS is, if we just move to the next slide there, please, Hannah. One of the things you're seeing in the RNS is sort of talking about some of the green shoots. And certainly we've seen some improvements in the marketplace. First of all, it's opening up. We've already been out to the Chicago Fair. That was great. Saw customers face to face, in many cases for the first time in 3 years. In April, we've got the Canton Fair, the biggest show in China. And again, first time in 3 years, brands, retailers, and OEMs will be able to meet face to face, which is really positive for Strix. We tend to meet something like 120 of our customers during that period of 5 days in China, giving us a lot more market intelligence. If you look at the right-hand side of that graph, I mean, you'll sort of see the OEM activity, and that's a really important measure of what is happening in China in the manufacturing base. So if you look at Q4, the actual capacity of our top 5 OEMs was only 65%, which means 65% of their production lines were running at full speed. Normally in a Q4, that would be somewhere between 95 and 100%. So very, very low, based on historic data. And then when you look at Q1, we're actually looking at 83% capacity. Normally that would be much closer to the 70% this time of year, because it is actually the quietest period in the year. So certainly we're seeing an increase in demand, which is obviously very positive and encouraging. And that's also supported by the graphs on the left-hand side there, which are looking at one of the online retailers, which are actually showing a 17% increase year on year for the kettle market itself. So definitely we can see signs of a pipeline rebuild. It's too early to say it's the rebound. We need a little bit more data, a bit more trading before we can be sure of that, but definitely some green shoots and encouraging signs as we come into the new year, 2023. If we can move to the next slide, just a quick look at the Billi acquisition. Many of you will have heard about Billi. It is the number 2 player for premium hot tap systems, a great little business, and we did manage to secure that at an incredible price. I won't go through the whole process. It can be a very long story if I do that. But just to give you an idea, we ended up buying Billi at a price of 3.8 times EBITDA. The original bids that we had were for 11.5 times EBITDA, and there were 11 bidders, we believe, in that process at the time. And the reason we managed to get it at that low price was purely a matter of timing, and I'd like to say a little bit of negotiation skills as well, but primarily it was around timing. We had lots of discussions with the CMA during a period of exclusivity. We got very comfortable that we would be a appropriate buyer for that business, and therefore the quickest way for that deal to be done was to work with Strix to close the deal. And that really was the primary reason that we managed to get it at such a competitive price. And certainly what we've seen so far has also been very positive. Just looking at sort of the progress we've made today, if we just move to the next slide, please. I'm initially just talking about some of the things that have happened. We've owned the business for around 3 months now. The team in Billi have done an excellent job. First of all, year to date, we're just about on budget, so everything is going as expected. We've had some very big contract wins in both Australia and New Zealand. That's been very positive. We've removed all of the links with the previous owners, other than just one warehouse. That's the final part that we need to do, and we're in progress with that at the moment. In the UK, there was a bit more work to be done when we acquired the business, because they were not expecting to split the UK out until the CMA got involved and insisted that was broken up. But there, we've set up a new head office in Wolverhampton. That was done within the first month of ownership. We're just about to sign the lease on a new showroom in London, in the Farringdon area, which is really close to all the surveyors and architects. So prime location for this business as well. We're in the process of moving all the stock into the Strix warehouses, so that's very much underway at the moment. We've taken on all of the HR inside Strix now, so that's already been removed. And really the last part for the UK is to get the ERP system transferred over. We've identified the systems. We're going through the migration of data as we speak at the moment, and we plan to have all that completed by July. So the team is doing a fantastic job, and we're very much on target against the schedules we put in place. And as I say, the business is actually performing well in the first quarter of the year so far. So very, very happy with progress being made. And if we can move to the next slide, just to look at the way Billi changes the business. I mean, it really is a transformational acquisition for Strix. You can see that for the full year this year, we'll be looking at kettles being around 53% of our overall business. You may remember, those of you who were talking to us when we listed, we were about 93% revenues for kettles. So very, very significant change. The other very important part of that, Billi is actually very similar in terms of the way it works in its balance sheet to the Strix core business. It's highly profitable. Your margins are circa 50%, gross margins that is. It's also very cash generative, cash to EBITDA ratios of around 70%. So it fits very, very well within our business, but it also expands our portfolio of products. If I can just move on to the next slide, which is my final one for the summary at least. This is sort of really looking at our capital allocation priorities. Obviously, the acquisition of Billi has increased our debt profile somewhat. We've actually increased our net debt now to 87 million at the end of 2022. But we are a very, very cash generative business, only strengthened by the acquisition of Billi, as I've mentioned already. And we're now really working to prioritize the integration and the unlocking of revenue and the cost synergies within that acquisition. But we're also prioritizing our debt reduction and our free cash flow with a very, very clear plan to get the debt below 2 times by the end of 2023 and well below the 1.5 times by 2024. And based on the information we have around us and based on the confidence we have in our numbers for 2023, the board has already committed to the final dividend of 3.25 pence. That will represent a total dividend of 6 pence per share for the full year. And just as notification, we will hold our AGM on the 4th of July on the Isle of Man, and we will actually hold an Investor Day the day before that on the 3rd, so people can come over and see the facilities on the Isle of Man prior to that AGM. So that is a bit of a background summary. I'll pass over Raudres to go through the financials, and then we'll come back and look at a bit more detail in some of the categories.
Thank you, Mark, and good morning, everyone. So top line declined 10.5%, where we removed the 1 month of Billi's acquisition, Billi's addition. The organic growth or decline was 12.5%. The Billi added to the group in the month of December, and that contribution of revenue is 2.7 million, and it was the slowest month of the entire year of business. The drop in revenue is largely due to the Kettle Controls of 20% drop year over year, and water and appliances were both at 13% improved year over year. And if we exclude the Billi contribution, then organic water was growth of 8%, and organic appliances was 1% sort of flat growth in a declining market. Adjusted gross profit margin dropped 12.4% in absolute profit, and in terms of margin, it was at 38.8%, which we suffer a modest setback of about 90 basis points, and we thought that was held up quite well given the top line hit in the regulated controls market. Adjusted EBITDA margin, we saw a 20.7% in decline in absolute profit. And we, in terms of the operating costs, we faced very strong headwinds last year in the supply chain and sales distribution cost. And this has eroded our consumer goods earnings. Right now, the supply chain team and the commercial team work together on coming up with very good diligent measures where we're trying to optimize the distribution costs, and where we'll continue to plan our growth of the consumer goods into expanded geographies. In parallel, our digital team is also working to negotiate with Amazon, where we're trying to unwind some of the terms and conditions, which was signed up by the ex-Leica owners at the time. And that has we have gaining good momentum on that. And the hope is obviously to improve the quality of earnings of the consumer goods. In terms of administrative costs, if we take away Billi, we managed to reduce that by 2% year over year. So that was a very good efforts on our part. Billi, with the month, have added 500K to the group's admin cost. Adjusted PAT declined 26.7% in absolute profit, and that was EBITDA drop through of 8.4 million. There are 3 moving parts between the EBITDA and adjusted PAT, and they are the D&A, which is depreciation and amortization, that we saw 600K of improvement, and that is due to the change of accounting estimates of useful lives that we mentioned during the interim's time. And we also saw good savings in the tax area, where we got good tax grants and credits from the Italian and Chinese government. And with the relocation of the factory, the Chinese authorities on the tax department confirmed with us that all the liabilities are cleared. So we're comfortable to release the tax provisions as well. So all these together give us a 1.7 million savings. And the above two items that I talk about completely offset the higher interest costs and refinancing costs of 2.3 million. Then net debt increased to 87.4 million, which is where 30 million of that is due to the acquisition of Billi. So if we can turn to the next slide, which is where we can walk through the cash flow waterfall. This waterfall slide shows the major use of cash and capital allocations led to the net debt of 87.4 million. First of all, the EBITDA contribution was 32 million, and net working capital outflow was substantially reduced from FY21 of 11 million to last year of an outflow of 2.6 million. That was a substantial improvement, which is concerted efforts on all departments in Strix, where we try to reduce the supply chain, tighten up the supply chain planning, and also on the negotiation on the creditors' terms and more diligent collection of all the AR and so on. So it's now back to the normal working capital pattern of Strix, which is a very modest swing of that net working capital. So moving forward, we will continue to maintain this very tight practice as the cost of funds have gone up substantially. Financing costs here have gone up due to the rising SONIA, as we all aware of, and the higher debts as well, but it was offset by lower taxes payable due to the tax grants that we got in the year. Exceptional costs incur mainly due to the Billi acquisition costs, and there was a Leica earnout payments of around 2 million. And in terms of more earnout, there is one more, which is due for the FY22 performance earnout, but however, it's based on a very steep ratchet scale. And based on our calculation so far, it doesn't look like it would trigger any payment. CapEx and captive costs was managed very tightly to reduce to 8.6 million. And we will continue to maintain a very tight review on all the CapEx spending. So dividends, cash outflows here of 17 million was for last year final dividend and the last year of interims as well. We did do equity raise for financing Billi, and that was the major, and 10 million was used to deleverage the term loan. With all these, the cash conversion was 61%, which Mark alluded to, which is a substantial improvement from the previous years of 29%. So on the next page is a breakdown of the net debt of 87.4 million. So as a start, it was 129 million when the deal was completed at end of November. And then we got the equity raise of 10 million that paid off a part of the term loan. And then at year end, our cash and facility headroom was at 30 million. And so that lead to the year end of 87 million. So right now we have two bank facilities. One is the RCF of 80 million that we always had. The other one is the term loan of 3 years, which was incurred due to the acquisition of Billi. And it was on the 11 fixed quarterly payments of 3.55 million per quarter. And we will completely pay it off by the third quarter of 2025. And in terms of facility covenants, two are in place. One is the leverage covenant, which is 2.75 times multiple. It will drop to 2.25 starting from July onward this year. In terms of the DSCR ratio, we have to maintain at 1.1 time on the minimum. And the next slide is the net working capital balance, where we try to compare and show what is the normalized net working capital. So from year on year, we can see that reported at a 9.6 million increase to 27.6 million. And out of that increase, 6 million came from Billi. And then the rest are the releases of the tax provisions, which I talk about, which is non-cash. And then inventory increased modestly by 700K because we need to plan for sales increase to cover the stocking requirement. The AR, we did very well, where the VAT 4 million was collected from the Chinese government in the earlier part of the year. And for accounts payable, there was a reduction there because we have tightened up the procurement activity, so that balance has reduced. And if we look at the normalized working capital, we just have to remove the one-time adjustment, which is the Billi working capital of the 5.5 million and the tax provision release of 1.3 million, then give normalized working capital of 20.8 million, which pretty well sync up to the 21 million as we have projected at interim. Yep, so the next slide talks about exceptionals. I think there's been confusion on the exceptional cost that was incurred, booked on our books over the years. It sort of appear as regular exceptionals. But in fact, if you look at the breakdown here, you see that there has been 3 acquisitions that was made in the last few years, along with a major investment in the land and factory. So in 2017, that's where we got listed IPO. And then 2018 and 19, we bought Halo Sauce, which was spent over the 2 years. And like acquisition started in 2019 and finished in 2020. The Billi acquisition started in the earlier part of last year and finished in November. However, going into this quarter in 2023, we will continue to incur some legal costs and valuation, accounting, transfer pricing, compliance, it's costs like that. But it is going to be much lower than the previous years, as we don't have plans to do further M&A in the medium term. We are going to look into internal streamlining program, and so altogether with some of the post-Billi legal and accounting work, the estimate of exceptional costs is drastically reduced to between 1.5 to 2.5 million. So if we look to the last page in the finance section, so there's a technical guidance that we provided this year because there's a lot of information that we want to align the assumptions of the last year and projection in the new year. The effective tax rate will be about 11 to 12%, and that is because of the addition of the Billi at a corporate tax rate of 30%. The CapEx, 13.5 million included the 2.5 million of Billi addition, where especially on Billi UK, where we need to start up Billi UK with the London showroom, the new offices, and ERP system, and so on. So all those are one-time CapEx we need to invest, along with Australia, Billi Australia, where they're launching new products that they need marketing tools and to enhance the automation of the production line. And if we remove those one time, we're looking at 11 million. This is a bit prudent on our part to project that. Seriously, we won't approve all the CapEx that comes along the way, but for our cash flow projection, we're trying to be prudent here. Depreciation and amortization is 8.5 million. That include the Billi D&A of 1.2 million in the numbers. And the net interest is 9.2 million. That is reflective of the latest SONIA curve. And so with that, that concluded the technical guidance, and I'll pass back to Mark.
Thanks very much, Raudres. Yeah, hopefully you didn't get any disruption in the transmission there. We did have a few problems with our screen, but I think we're back up and running now. So if I may now, what we'd like to do is to go back into the categories just in a little bit more detail. We've obviously talked quite a lot about the kettle side already, but you can sort of see over the last 2 years, we've seen a drop in the kettle market in CAGR terms of about 5.1%. As I mentioned at the beginning, historically, that has always rebounded when we see the recovery. Too early to say we're in that position at the moment, but we would certainly expect the kettle market to do as it has done in previous years and rebound back to a 5% CAGR growth. And hopefully we'll get a lot more information when we go over to the Canton Fair in April to just see where we are in that phase of recovery. I think it's worth noting that obviously the situation in Ukraine, Russia has had an impact on our business of about £5 million. And that is because we are not selling obviously directly into those territories, but also some of our key customers, particularly some of the major brands, are also not selling into those territories. So at the moment, there is a step change, if you like, in our addressable market of about 5 million. But excluding that, we've managed to maintain our share within the market from the data we have. I think in the kettle market, it is a mature market without doubt, but there's actually quite a lot of exciting things going on. Unfortunately, some of those are commercially sensitive, so we're not going to show them all on here. Obviously, if you come over to our Investor Day in July, you'll see a lot more of these face-to-face. But the sort of areas we're looking at, we are still working on our next generation control. That's making really good progress. Physically, it is quite a lot smaller. Obviously, there is some improvements in cost in doing that, but also some very significant improvements in the specification of the products as well. And it will allow it to be used in different types of appliances, things like travel kettles, for instance, which are physically much smaller, where previously our controls would not be able to physically fit in those appliances. So it does open a slightly bigger addressable market in that region as well. But we're also looking at a lot of new products in the kettles themselves. Industrial designs. We have a range of industrial designs we're going to take out to the Canton Fair in April, and a lot of these are linked to sustainability, really trying to help the consumer to change their behavior to save energy when using kettle appliances. So that's really exciting, and the fact that we can now physically get out in front of our customers will obviously allow us to push those much harder and to leverage on future sales as well. The next slide just shows you just how what we call the bullwhip effect takes place. And I won't bore you with every box in here. There's a lot of detail, but effectively what happens is what you see is that there is no stock in the consumer end of the market. And we saw that at the back end of last year. Many brands were telling us they would rather be out of stock than actually spend cash in Q4 of last year. Again, quite unique in the marketplace. And that was really because the interest rates had no limit at that point in time. And there was lots of nervousness about the market. So they wanted to preserve cash for their year-end results. We have started to see some of those major brands start to reorder, which is obviously positive. As I say, at this stage, still green shoots rather than any form of recovery. But as that recovery does come back, what you see is this pipeline starts to sort of kick in. And every time you go through a stage of this pipeline, you amplify the need for volume at the component end of the business. So typically it takes about 14 weeks for a retailer to place an order onto a brand and then onto an OEM, and for that product then get on the shelf in one of the Western countries. So there's a long delay, and therefore they have to buy more products to make sure they can fill that pipeline while they're waiting for that 14 weeks. That can mean up to a 35 or 40% increase at the Strix part of the components. And that's certainly what we've seen in prior events historically. 5 events over the last 16 years that I've been involved in have always shown that bounce back. So as I said earlier, it's really a question of timing as to when that will happen, and we're very confident it will happen, just a question of when. So then we're going to move into the consumer goods, and this is an area that had quite a lot of publicity from various analysts over the years in terms of our ability to be able to grow this part of the business. Back in 2020, we came out of the Capital Markets Day and said we would expect organic growth at 25% CAGR year on year. Actually, when you look at some of the results in here, there's a lot of very, very strong positives that I want to sort of talk about today. As a consumer group overall, we only saw a 1% growth year on year, which doesn't sound particularly exciting, but you've got to remember that's in a backdrop of a market that dropped by 16% during the course of the year. So actually we are gaining share and we are getting quite good momentum. If you look at our own brands, things like the Leica, the Aqua Optima all combined, we had an 8% growth year on year. Again, in a market that's declined by, we estimated around 16%. And if you look at specific brands, as you can see in those call-out boxes, the Aqua Optima brand actually grew 49% year on year. So well above the targets that we had in the marketplace at the time. And then a lot of that is through further contracts being won, getting further geographical expansion into the marketplace. And we've already seen 6 major contracts at the back end of 2022, which give us very good confidence of about 30% of our projected growth in 2023. Also, a lot more channels. When we started this, it was just on Amazon. Now we're starting to go through a lot more digital channels. We're also getting coverage in North America as well. And those themselves will give us something like 25% of our annualized growth in 2023. So very, very confident in the ability to be able to continue to grow those markets, and very confident on those growth rates of the 25% CAGRs that we reported back in 2020. The downfall in the market for us was on the private label, and the private label for Strix tends to be some relatively large appliances from other brands, obviously, and that are a little bit more discretionary. And they saw a softening of around 11%, which obviously subdued the growth. And if you remember back in the 2020, for those of you who've got good memories, we did say that we were trying to actually put more emphasis on our own brands because we were so dependent on those private labels. Clearly, we're going to continue with private label, but as we increase our brands, we will have much more control of those growth rates going forwards. So overall, we are very positive. And now we're going to break down into the various two categories, starting with the appliances, if I may. We've seen some really good results here. You can sort of see the CAGR there of 59% on the appliances. I mean, that was driven primarily by the Aurora range of appliances that were launched just over a year ago now. They are devices that give you hot water, or in fact, true boiled water, I should say, chilled water, purified water, and any temperature in between. They're not plumbed in. There's no preheating of water. They're really good from an energy efficiency point of view. And we've actually won a number of awards, including one which was the Sustainable Product of the Year award from the Housewares magazine. So it's been very, very well received in the market. We've now brought out 3 products in the range. Still some more to come out during the course of the year. We've got the Aurora Coffee just about to be launched. And we took that over to the Chicago Fair back in March. Really well received in the market. So that will start being sold in Q3 of this year. And we're really excited about the prospects for that as well. So when we sort of look at where we are, I think things are progressing very well. We are going to, sorry, the screens are just dying again, just bear with me. In 2023, we are going to launch our first sparkling system as well. So we sort of really get into that market before we put it into the Ontario systems during 2024. We've launched the first variable temperature filter kettle. So that's an electronic kettle using a filter as well. That's just coming onto the market as we speak at the moment. I've mentioned the coffee machine already, and we're bringing a range of air treatment products out in our Italian business under the Leica brand as well. So very strong roadmap of new products, and we remain very confident on those growth numbers, on the growth percentages that we discussed back in 2020. And I think now with the world opening up, we have much more ability to be able to go and see the brands and the retailers face to face to be able to promote all of these new products and technologies that we've got to bring to the market. We move on to the water filtration. Quite a similar picture in many respects. From a growth perspective and a CAGR, looking at a 26% CAGR. So again, in line with the growth rates that we were talking about back in 2020. And you can see sort of the growth rates of the brands themselves, 14% for just the water part of the Aqua Optima and 5% for the Leica part of the water systems. As we move into 2023 in this category, we're moving very much onto the sustainability path. We're looking at recyclable filter bags as an example. We've got some really strong new listings in UK supermarkets, and you're certainly going to see a lot more of the Aqua Optima branded products, and you'll see a lot more of the Leica products coming into the UK as well. Perhaps one of the most exciting, and it seems unusual, and I was never expecting to sort of stand here and be excited about a fridge jug, but one of the most exciting products we brought out is what we call the Perfect Pour. And that is a fridge jug that is now manufactured in our China factory. So all manufactured within Strix, with a patent, in fact, around the way the water pours through the jug. And it is really quite unique. You have to try one to see how good it is, but you don't get any of the splashing that you get in a lot of these devices. You can empty the jug completely without sort of mixing the filtered and non-filtered water, and it doesn't leak at all. So it's a very simple device, but actually, again, has been really well received in the market. We've taken it out so far, and that will be rolling out to the various channels that we have during the course of 2023. And then obviously, the Billi also now adds another option to that total water solution, and that will unlock new areas in the professional market. So for instance, the Aurora water station would be perfect in offices like I'm sat today, where you've got showrooms, and quite often you'll have plastic bottles of water, or you'll have people actually coming in to make teas and coffees. The Aurora coffee would be able to do all of that for you in a device like this. And certainly the Billi route, who's going into those offices all the time, will be able to cross-sell some of those products into those markets as well. So the next slide for me was really just sort of trying to demonstrate that the lights are being switched back on, and this is really positive for Strix. It's really important we can get out in front of our customers. We want to sell the benefits of Strix, all the services we provide. Much harder doing that on Zooms and Teams. If you can get out in front of people, you can physically show them product. It's obviously a huge advantage. We've already been out to Chicago. We've already been out to Dubai as well on a medical show as well. Some people actually had the real benefit of going to Birmingham in a recent show as well. And then we've got the Canton Fair coming up shortly in April. So the world has definitely reopened, and that's giving us a lot more opportunities to get face time with our customers. So we really are sort of seeing that new normal come into effect. So if I can move on to the ESG side, couple of things here really. First of all, as I said, we are now operating as net zero in scope 1 and 2 for our core business, as we had said we would. So that's all very positive. More than 10% of our energy now is from solar panels that we put in various locations. And we've also managed to reduce our offsets, as I mentioned, to 3%, where our target was 5%. So really our focus is now all on scope 3, and that accounts for 98% of our emissions. 94% are in use, are in the in-use category. In other words, when you're boiling your kettle, that's where most of the energy is taken. And so we're doing a lot of work in places like our engineering systems. I mentioned that we've got some new products. For instance, we'll be able to show the temperatures on the side of the kettle to show what temperature the kettle is at. But more importantly, it will show you that the kettle shuts off well before it gets to boiling, and the inertia of the heating allows it to then go to boiling. That will save anywhere between sort of 3 to 13 seconds of boiling time, depending on how effective that kettle is. That's a significant amount of energy that can be saved just in the boiling process of a kettle. So we're also looking to find ways of changing consumers' behavior. For instance, things like the Aurora will only ever boil the water you need. No preheating of water. Is effectively room temperature water that you're using. Obviously, that's got to be a very, very good solution to reduce the amount of wastewater, but also to reduce the energy consumption as well. And we're focused on things like transportation, packaging, and the freight costs as well. As of Wednesday, we put a new document on our website, so please go and have a look. That really does set out our plans for ESG over the next few years. And you'll see there, as on the next slide, a number of the targets that we're going after and the commitments we're making to reduce or improve our performance in the ESG. Sorry, Hannah, if you just switch one slide. These are some of the targets year on year. I should point out, I mean, some of these targets look really impressive when you start looking at a reduction of 34% in water wasted energy and so on. We were running 2 plants for a period of time. So whilst that is very good and we're very pleased with that, we've now got a new base effectively with a very efficient new factory in China. And obviously going forward, we will continue to make reductions, but we're targeting between 3 and 5% year on year in terms of reductions of things like wastewater and energy intensity usage. But all of those targets and KPIs are outlined in the document we've put up on our website. So then finally from me, I think we're just about on the right time, just in terms of the sort of summary, the sort of trading outlook and guidance. For me, just to summarize where we are, the lights have come back on, particularly in China, which is now running back as normal. The threat of lockdowns has been removed, and we're seeing OEM activity at very significant levels of 83%, which is very high for this time of year. Early indications from some of those online channels, 17% uplift year on year. That's got to be a positive sign. Still not a recovery, as I say. We need more data before we can confirm that, but definitely a very, very different backdrop to where it was in Q4 of last year. So very encouraged by that. We have some very good contract wins in the consumer goods category in 2022, which does give us confidence in those numbers. And you will start seeing more and more of the Aqua Optima products and the Leica products in the UK market, but actually across Europe, you'll see some significant increases in visibility of those brands. But we're not complacent. There's still lots of work to do. We've obviously taken on new debt. We are continuing to focus on cost. We are reducing the capex and exceptionals, as Raudres explained to you, to the more normal levels of Strix. And we're going to be prioritizing debt reduction and free cash flow to really drive that debt to EBITDA below 2 times this year and well below the 1.5 times in 2024. And given that backdrop and the confidence we have in the market for 2023, we have as a board declared a final dividend of 3.25 pence, which makes a total dividend of 6 pence for the year. And then finally, the integration of Billi, we're really pleased with the way that's going. As I've said, it really is going to propel Strix into a new growth phase and giving us very good and positive further diversification of the business with some great upside opportunity in the longer term as well. So with that, I will stop talking for a few seconds and let Hannah come back with some of the questions.
Thank you very much. And we've had a lot, so I will endeavour to get through as many as I can. Right. How will increasing UK corporation tax to 25% affect the business?
Our business is quite unique from that perspective. We're obviously Isle of Man based, and we manufacture most of our products in China, and it's used as a sort of contract manufacturing process. So anything that we actually invoice through the Isle of Man is zero tax. So it will have very minimal effect. There's a very minimum amount of our business is being taxed through the UK.
Okay, thank you.
Other than Billi UK.
Correct. Sorry. Yeah, Billi UK does change that profile slightly. So that one part that will be impacted slightly.
Okay, thank you. Right. Lots on debt. I'm going to try and pull a few of these together. In the results released on Wednesday, the maximum covenant noted was 3.5 times. However, from today, it looks to be 2.7 and then 2.5. Please, could you clarify? And I guess tying into that, somebody else is saying, are you comfortable with the 2.5? Will you be able to meet that? Do we need more headroom? Go with those two to begin with.
Well, obviously, we are very conscious of all the covenants in place, and we will manage diligently of the funds, of the use of funds on capex, on spending, and so on. So Strix is very cash generative along with Billi. So we are quite confident that we can manage within those headrooms.
Okay, thank you. Another one, would paying down debt faster rather than paying a dividend be a better use of cash?
Yeah, I think we spent a lot of time as a board discussing dividends and how we should balance that. Yeah, we're very happy with the 6 pence dividend. We've got almost a 2 times cover on that dividend. So yeah, we're very comfortable that that's an appropriate amount. Clearly, it was a reduction, and that reduction is trying to balance the desire for dividends by a large part of our investor base versus getting that debt down. Yeah, we've obviously put the targets down to be below the 2 and the 1.5. Yeah, we will obviously work to achieve greater reductions than those. We are being prudent in the numbers that we put out.
Thank you. Another one on debt. Do you expect to pay the overall debt more quickly beyond the RCF, or do you think it will remain at 80 million by the end of 2025?
Yeah, obviously on that slide there, what we show the debt profiling is just to demonstrate the term loan, the amortization. The 80 million shown there is just the RCF maximum, but obviously any excess cash we got, we'll deleverage it.
Okay, thank you. With the interest rates rising, what interest is being paid on the debt?
Interest is 9.2 million we projected in the new year.
Okay, are you happy to disclose the rates on that? I'm sure they can reverse engineer it, but
well, we are right now at the margin of 2.85% plus the SONIA margin.
Thank you.
That is actually on the pack that's been sent out as well, Hannah. That's broken down in the various ratchet scales.
Brilliant, thank you. Right, I think that's everything on debt. I'm trying to scroll through them all. Let's move on to pricing. How much have you been able to put through in terms of price rises in the inflationary environment?
Yeah, we put in the last 2 years, we put 2 price increases through. So we've tried to actually offset the inflationary cost of commodities in particular. We also do a lot of lean initiatives inside to try and offset any of the costs, of labour increases and so on. So that's always been a focus for us. Obviously, we're looking at the markets as they are today still. There has been an improvement, let's put it that way, in terms of some of the commodities, although silver and copper are still quite stubborn. There's definitely been an improvement on the plastic side. But obviously, you've got other costs in terms of energy costs and so on that are still very, very high to previous levels. So we will continue to put in price increases that we feel are appropriate to offset those increases. And I think, one of the things that we're doing for the course of this year, we've already put some price increases in the consumer goods segments. On the kettle side, we will get a lot more data when we go over to China and we meet all our customers and suppliers and so on. But no doubt we'll be looking at an appropriate price increase to come in following those events.
Thank you. Can you comment on expectations for the unit basis for the core Kettle Control products?
I'm not sure I understand what you mean by that one.
I guess you've got new products that you're going to be launching, haven't you? Is there an expectation perhaps that the pricing per unit will be more competitive on that basis?
That's a quite a wide-ranging question. So if I break them down very quickly, if I look in kettles, the next big thing we're going to bring out is a next generation control. I mean, that opens up new opportunities, which obviously will be able to command a price premium without any doubt at all. But it is also at much lower cost, so we'll be able to be much more cost competitive in those areas, in places like China, for instance, where your margins are always very constrained. So that prices will vary depending on the markets that we go into. When you look at the new products coming in terms of kettles and you look at some of the appliances, without doubt, these are new technologies. Yeah, they've got very, very strong and unique messages. A lot of them are patented technologies, so they will be able to command a premium, and therefore they will be at a higher price point than existing products. I think that's one of the benefits of the world opening up. We can actually now go and promote that, and we can actually sell those benefits, which is much harder to do on a sort of virtual site.
Okay. Obviously, you've just opened the new factory. Geopolitical risk in terms of an invasion of Taiwan. What is there anything you can do to diversify production?
I mean, I think we've done an awful lot. I mean, yeah, we used to be, 100% or 93% in China when we listed. Today, this year we're going to be 53% is going to be kettles in China. And we've got the factory in Leica now that we've opened up. We've increased capacity in Leica. We're actually now producing a lot more of the filters in Europe that are being sold into Europe. So that's already diversifying. And obviously we've now acquired a new manufacturing facility in Australia. I mean, the one that is more difficult is the kettle side of the business, because China actually makes 93% of all the world's kettles, and it is by far the largest market in the world for kettles. So whilst we could quite easily move our production sites out of China, all we will be doing is shipping controls into China to be fitted into kettles in most cases. But I would say, in the worst case scenario, there is always the options to be able to move our production facility. We used to have it all on the Isle of Man, if you go back plenty of times ago. And it takes us, so we've proven this with the new factory, somewhere between 6 to 8 weeks to dismantle and reinstall and set up those automated production lines. And today, 77% of our production lines are fully automated. So it's not so hard to move if we had to.
Very helpful. A couple of questions here on share buybacks and management purchases. Do you have plans for either?
I mean, we look at all options. I mean, there are no immediate plans for things like share buybacks. It's something that we obviously monitor depending on where the share price is. I'm not aware of any purchases at this point, although clearly it's quite an attractive position where it stands today. But I don't have visibility at this point.
Okay, thank you. Share-based payments have occurred every year since IPO. Can they reasonably be described as exceptional?
I mean, I think that's one of those arguments. We sort of get mixed views from our investor base as to whether it should be or shouldn't be. I think the one thing I would say is we always disclose that number, so it's very clear. And I think this year in particular, we've tried to be much more transparent on what is exceptional, what is not exceptional in our numbers. But we do treat the share-based payments as exceptionals. You can see that number has come down to a much more sort of normalized level following the very initial one that we had at IPO. And I think you can just carry that number forward with sort of certainly as a maximum number.
Okay, thank you. Your new coffee products that are coming out, will they work with the existing coffee pods of leading brands like Nespresso? And what about the forthcoming recycling pods that the larger brands are developing?
The answer is definitely a no at this stage. The system we're bringing out is more of your drip coffee type systems. I will say it will have the SCA approval, and I believe there's only about 10 products around the world that actually have that approval. So it is a very unique product, which gives you very, very high quality coffee. Obviously, those types of products are very attractive for the US market in particular, where drip coffee is obviously very popular. But it's also worth noting that actually pods are becoming increasingly less popular because of all the recycling issues. Certainly some of the standard ones out there today. I know there are recycling pods coming out as well, but there is actually a bit of a trend back to those drip coffee type systems where you're putting your own coffee in.
What is the future capital investment into Billi specifically for?
Future investment for Billi is for this year is for the Billi UK setup cost, the London showroom, the ERP systems and all the hardware on IT equipment and so on, because it's literally have to separate out from the seller. And then for Australia, it's going to be the automate a bit of a new assembly line for the new product that's going to be launched in Q2, the end of Q2.
Sticking with Billi, what are your aspirations for Billi, and how do you narrow the gap between yourself and the market leader?
I mean, that's a really good question. I mean, I think Billi has huge opportunities, and we certainly aren't reflecting those at this point in time. Billi, in my mind, is the premium product in the marketplace. I mean, it's a water cooled system, highly energy efficient. The one failing it had is on the original systems, you needed 2 taps to get all the functionality out of the system. The new product that Roger's just referred to will come out in Q2 in Australia, Q3 for the rest of the world. That will give you one tap that does everything, including the sparkling water, and it will really give us an opening into the residential market segments as well as the professional segments. I mean, in terms of the market leaders, Billi and Zip are sort of number 1 and 2 in those 3 major territories and have been, and they really do, between them, dominate the professional space at least. I think we have a very, very competitive product, and I'm very, very confident we will be able to both gain share, but also to actually get new market positions as well. And I think the other thing you have to remember is that Billi really only sells in any volume to UK, Australia, and New Zealand. You know, Strix has a much wider geographical footprint. We've got offices in China, Taiwan. We've got offices in Hong Kong, obviously in Italy now. So lots of opportunity to use those footprints to expand Billi to a much wider group of territories.
Thank you. Do you break down the sales by channel for Billi? And if so, which is more attractive?
We don't. I don't have that here. We can break it down, and we obviously have got data through the sort of due diligence process of breaking it down. There's not much difference in terms of what's more attractive. I mean, Billi commands 50% gross margin. It's very, very positive and very profitable business. Obviously, the service contracts are also very attractive because you can sign those up for up to 5 years in some cases. But generally, the business is around that 50% margin, regardless of whether it's consumer or professional use.
And what is the price point versus Kruka?
Very different. It's a completely different product. So I wouldn't necessarily compare Billi with Kruka. It's much more related to people like Zip, for instance. So it's almost like having a mini fridge under your sink with a Billi system. It's all self-contained, it's water cooled, and the refresh rates are very, very high. And we're using energy for the chilling to actually preheat the water, so it's very energy efficient as well. I think, you know, what you've got to think about is if you look at our roadmap of products, you know, Strix has some very, very good appliances, and we're continuing to push those into coffee, for example, and the hot water dispense, but as standalone systems. Now we've got the very top end, the premium product, in my view, in that marketplace, which is Billi. You know, obviously, we're going to be looking to fill that gap with Strix technologies and some of the Billi products as well. So, yeah, so watch this space for the middle ground.
Brilliant. Can you talk about general market penetration of instant water taps in the different geographies and any reasons that might explain the differences?
I don't have the exact figures here with me today. I mean, certainly it's something we can put more detail around. I mean, UK is still not that high in terms of penetration. I mean, you're looking at sort of, less than 500,000. Whereas when you look at something like a Kettle, you're looking at something like 10 to 12 million a year. So they're very, very different markets when you look at those. Yeah, Australia is actually slightly higher penetration. I mean, it's just the way that they actually interact, if you like, with their sort of devices. They've got a lot of space and so on. But actually in many territories it's significantly below the 10% mark, probably with the exception of the US, which do have quite a high percentage, but I don't have that broken down at the moment.
Okay, thanks. The inclusion of Billi, does this result in a greater internal sourcing of components, and will this lead to a further tick up in the level of factory automation?
I mean, there's definitely some opportunities. Yeah, all of the products in Billi today are sourced in Australia. You know, we have a procurement engine, if you like, in China, working with some of the top OEMs that can provide very high quality components at very competitive prices. So there's certainly opportunities there. Yeah, there's also other things within the Billi system like filters, and clearly there's some synergy opportunities that we're going to look at. So there's definitely some good opportunities and some low-hanging fruit, for want of a better word, in terms of getting some cost benefits within the group as a result of that addition.
Thank you. Okay, on to growth and margins. A couple of questions here on organic growth. What assumptions have you made for next year? And then historically, what was the group organic growth revenue in 22 and the organic EBITDA in 22?
Is it about, okay, first of all, organic growth on top line?
Yeah,
let's go with that.
Well, it depends on what category. So if it is Kettle, the CAGR growth, it's been 5% historically. So we can only talk about the CAGR growth, given that's the trend. So it would be between 3 to 5% on Kettle Controls. And then with the water, organic water and appliances, our CMD day target set at 25%. So yeah, we did see some softness last year. So, but on the longer term, or even the medium term, we are set on the 25% growth rate.
Thank you. Should we expect margin recovery as volumes recover? And will controls get back to prior margins?
Yeah, a lot of the margins is in the mix of products. So it really does vary a couple of percentage points depending on whether it's regulated or China, which are very different margin products. So last year we saw a margin drop in the kettles of 1%, actually, which was very, very good considering the significant shortfall was in the regulated, which is our highest margin products. So yes, I think you can probably see a slight recovery over the period. Maybe 1 or 2% is sort of the variation you'll get, but it does depend very much on the mix of the consumer markets.
Okay, thanks. You talked about the bullwhip cycle. When you look to the past, how long have these stretched over?
I mean, typically the longest prior to this event was about 4 quarters, the dip going back to the rise. And the Kettle Controls, being a fourth tier supplier, is always one of the leading indicators. It's always one of the first to drop, but it's also one of the first to actually rise as well when you come out of those periods. This one has already been 7 quarters, so this is by far the longest period that we've had, in that dip, if you like. So, we'd like to think, we are getting to the end of that. And as I say, there's some green shoots, but just a bit too early to say that we are actually out or coming out of that yet.
Thank you. One for you, Raudres. Note 14 says you paid 4.4 million to the Leica vendors for post-combination services in FY 21-22. What did you receive for your 4.4? And are there any more payments to come? Why wasn't this all wrapped up in the sale and purchase?
This is about Leica, isn't it?
Yes. Yeah.
Correct.
Yes.
There are four deferred considerations altogether, where 3 of them were all settled in 2022, and the 2 more settled literally just last month. And then there's the 4th one, which is a performance condition that is riding on the FY 22 performance. And as I mentioned earlier, that is on a very steep retro scale. And then based on our estimate or calculation so far, based on the conditions in the SPA clause, it did not trigger any paid out at all. But obviously we have to send this to the ex-owners, and they would have to do their own review of that before we come to a conclusion.
Thank you. And just following up with you on the organic growth, if Strix grows Kettle Controls at 3 to 5% and the market's growing at 5%, are you losing share, or is the growth faster in unregulated markets?
No, sorry, there's a confusion there. One is unit sales, one is actual revenue sales. So the unit sales is 5%, so we'll be growing at 5 or 6% in unit volume, but in sales price, in revenue price, it's between 2 to 3% for the overall market.
Okay, thanks. For these Kettle Controls, where can this investor go to find the total market share data for your market share calculation, and who are the main competitors?
So really, really hard to get that data. We get it from a variety of sources. We've obviously got 56% share of the market, so we've got contracts and rebate deals with OEMs where we get all their data. We go and walk into all of our OEMs and we can see what production they're building and so on. So we get data from those. You can get data from export information coming out of China, but that's actually needs to be interpreted quite carefully. And then you've got things like the GfK, which is the other end, which is sort of data out. But you really have to look at all of those data points and do work to actually analyze the total market. And there is no one source of information that I'm aware of that will give you anything close to the real numbers. We spend a lot of time doing that market data. In terms of competitors, you've got one other outside of China. So there is only one, and that's a UK-based company. You can find it on Companies House. All of the others are China copies, as we would call them, of which there's about 5 or 6 of a reasonable size, and then the rest are very, very small. Almost sort of working in garage type environments, but the 5 or 6 others that are of a reasonable size.
How is the water opportunity in the farming industry that you've highlighted in the past progressing?
Yeah, that's been slow in the last 12, 18 months. They've had a lot of challenges there. I mean, the market itself in China has been very bad. Clearly, you've had loads of lockdowns. That particular part of the business is located in Shanghai, and we all remember the stories about Shanghai. So getting access was actually quite difficult. So we have had some slight growth in that division over the last 12 months, but really it's just starting to open up again now. So we have increased the focus on that with some additional sort of sales resource in China. Yeah, but it is a very small number in the overall targets that we had. And it's probably been delayed by about 12 to 18 months as a result of all of the pandemic issues in China.
Thank you. Have you got any steps in place to mitigate the implementation of the ERP system for Billi in the summer?
We are working really closely with them across with our IT division. So we've spent a lot of time, first of all, choosing which system it is. We've got consultants on hand supporting us to implement that, and obviously they will be there post that as well. We will leave the system running that is existing in WaterLogic for a period of time afterwards as a backup, just to make sure that we've got security of data before we do that. And obviously we've actually pulled off at acquisition all of the core historic data. So we've got a lot of securities in place, if you like, to make sure that we can manage through that process. And yeah, we have done it recently in Strix. We implemented an SAP system in Strix across the whole of the Strix business as well. So a lot of experience within the group to be able to do this.
I'm just going to keep you on for 3 short more questions, if you'll allow me. What happens when the IP expires and how will it affect the business?
We were asked this when we listed back in 2017, because a couple of the major Kettle IPs were about to run out, and actually we've grown our share by 2% since then, so it hasn't had any impact at all. I mean, I think one thing I'd say is IP is really important when you first come to market. It does give you a very good position when you launch, but actually we spend much more time on safety aspects and proving that some of the other controls, particularly some of those of a lower brand, let's say, fail the local legislation, and it's much easier to take them off the market. I would also say you can also take actions on products that have even expired. So we did that a few years ago now, about 3 years ago, on immersed kettles. Some of you remember those where you can see the element at the bottom. That patent expired something like 13 years ago, but we actually started a process for a company that was directly copying our controls, and that was under the copyright law in Holland. So even when the IPs expired, there are certain territories, Holland and America in particular, where you can take action against a direct copy.
Thank you. Can you give details on the cyber incident February last year and how security and control can be strengthened?
Well, that's a long time ago now. Yeah, we obviously, it was one of those things you didn't want to advertise too much. You sort of can't go out there and sort of say, yes, we've solved it and it's all no problem. Yeah, for fear of further sort of aggression, if you like. But no, that was recovered. We keep very, very strong backups in the business, so we will be able to restore everything quite relatively quickly. And we have put a lot of things in place since then, monitoring all sorts of attacks or potential attacks, and just strengthening our system continuously through the course of the year. And we will continue to do that.
And a nice one to finish on, where can we get more information about the Investor Day on the 3rd of July?
Either through yourself, or you can go directly to the info at Strix web email systems, either way.
Great. We will be sharing that nearer the time. So thank you both very much. That's 30 odd questions in 20 minutes. You did very well. And we look forward to an update in 6 months' time.
Great. Thank you very much. Thank you all for your time.
Thank you, Hannah.